Hey, how's it going? Volatility, that double edged sword. How much do you want of it? That's where the opportunities lie, so they say. Brokers will definitely tell you that, hoping you'll blow your account. My next guest, Chris Vermeulen from Canada, is one of those traders who takes a step back when volatility spikes. He also trades without leverage, and yet he's a very profitable trader. So, how does he do it? That's what this conversation will reveal. Chris has been trading since he was at high school. Today, he runs a weekly newsletter providing technical analysis on the markets. He's also in real estate and more recently has taken a role as an executive producer on a family movie. I usually see Chris in a suit and tie on various YouTube channels. Today, he's at home, no tie, just a shirt, well, pants as well, of course, and nice and relaxed, and we have a good conversation for around about an hour. Enjoy. Hey, Chris, how are you doing?
I'm good, Nicholas. How are you? Thanks for having me.
Yeah, absolutely. It's been a while getting on the show. We've had
Yeah,
various interruptions, but we've got here finally.
no problem.
Good. You're in Canada, right?
I am about 2 hours north of Toronto.
Okay. And that's where you grew up?
Yeah, born and raised in a little town called Collingwood. We're on a Four Seasons kind of around the lakes. We got mountain here. So, yeah, best of both worlds: hiking, fishing, skiing, swimming, sailing, all the good stuff.
Yeah, absolutely. And how did you get into trading?
Well, long story short, I grew up in the country where I am here, and we never had TV. My parents, we just never had it. So I grew up always playing in the woods, building things, hunting, all of that stuff, very creative. And eventually I went off to college in Toronto, and my dorm room came with cable TV. And I got addicted to two channels, which was Speed Vision, which I was all about the cars, and CNBC. And I saw people making so much money day trading and CNBC back then. I was like, wow, that is what I want to do. I'm an introvert. I'm like, this is perfect. I don't need to talk to people. I can do it from a computer. I can learn it on my own. And a TV ad came up for a newsletter that said, hey, copy my trades, $50 a month, and just copy what I do. I learned everything. You just do what I do. So I said, hey, I'm going to learn to trade. I'm going to charge $50 a month US, and I'm going to have 1,000 users. That was my goal right in my dorm room. And so I started to learn about trading. And I had already had a little bit of experience because when I was 16, my finance class in high school said, hey, we need to do a stock market challenge. And our classroom competed against others. And we didn't win, but we still made like $180,000 in a semester, picking random stocks. It was play money, but that would kind of got my toe in the water and getting addicted to it. And it wasn't long after that high school class, my dad got this booklet in the mail from Larry Williams. It was a marketing booklet about trading commodities and how you can make 50 grand in a couple of days trading pork bellies. And I was like, Dad, this is awesome. This is like better than stock trading. So I read this little booklet, I swear, like a dozen times or more. I shared it with my dad. He kind of laughed at me. He's like, there's no way we're trading futures. Like he didn't even really know what they were either. Um, and then, of course, when I went to high school, CNBC became my main thing. And I was like, oh my gosh, this is amazing. And I took some courses, I bought some books. Back then, CDs were big. So I bought trading courses on CD, went to some seminars, and I started to learn. And my roommate was in web design. And I'm like, hey, I want to learn to trade. If you can build a website, let's see if we can like help others. Let's build like a community. And so I've been doing this since 2001 from ground zero, learning. I still have some members from then, like a long time ago. It's pretty amazing. And I just evolved from there. I've traded all the different ways you could trade, different asset classes, time frames, scalping, day trading, covered calls, futures, all that stuff. And so it's just evolved over time. And I started with fundamental analysis, buying the best companies fundamentally that were growing quarter after quarter. When I learned I lose my shirt, even with the strongest companies during the tech bubble, I realized fundamentals actually isn't the way to do it. It comes down to technical analysis, follow price. If it's going up, hold it. If it's not, go find something else. And that was where I kind of come full circle to where I am now is, I'm a technical trader. I only care about price. I don't care about news. I have a way to track the direction, the strength of moves, and I know how to manage positions. And so that's my focus now is invest in things I know, I understand. I have ways to track multiple layers from sentiment to momentum to risk and volatility. And I stay in my lane. I know what I'm really good at, and I kind of stay in those asset classes.
Cool. Let's break that down a bit, your story into technical trading. What were the first things you started to learn? If we're thinking, we said price, but obviously supply and demand, support and resistance, these typical structures that we look for in a market, patterns and so on.
Mm-hmm.
How did you develop the skills that good technical traders have?
Yeah, so I went. I took a course. It was the company's not around anymore. I think it was called Invest Tools, and I learned they taught some basic technical analysis like stochastics and moving averages, um, relative strength. And so I really just started to look. They had a system where hey, you have to have these three indicators. They all need to show upward momentum and cross through, and it'll give you three green arrows if it's a good looking trade, right? If it's a buy. And so that kind of got my teeth wet a little bit there in technical analysis. Now I learned just enough from them that I went out and I bought the big thick book from John Murphy. He's like the godfather of technical analysis. I swear his book's like 1,500 pages or something. It's huge, but it'll teach you all the intermarket relationships, how all different asset classes are connected and linked in some way. Um, where money flows between them all. He teaches you chart patterns and things like that. But one of the best tools, like if you had to break it down to the most simple way, the 5 day moving average, the 20-day moving average, um, I find is the easiest and best way to navigate the markets. You want price to be, there's a couple things, basic criteria. The 5 day moving average should be above the 20-day if you're looking to buy things. The 20-day moving average should be sloping up, and price should naturally be above the 20-day or the 5 day ideally. And as long as that's the price, the price trend, you trade the uptrend. And when the 5 day is below the 20-day, you should be either out of the market or looking to trade inverse ETFs or bet against the market. Those time frames are really powerful for kind of swing momentum and position traders. And it's it just seems to be like the most simple way to track trends in the market and be able to get in and out multiple times through the year. So moving averages are key, and they're so basic, but they tell you, is it trending up on average or trending down? And I like to always have a shorter term and a longer term trend so I can confirm, okay, short term and long term are both in the same direction. If they are, then you've got a very good chance it's going to continue, right? So a trend is more likely to continue than it is to reverse. So if you know the trend, you're better to just bet with it. Eventually, you'll be proven wrong and it'll change direction. And then that's why you have position management and risk management. You get out, get stopped out, and you flip your trade or move to a different asset.
5 day, I use 9, but is this the simple moving average or the exponential?
I generally use a simple moving average, yeah, for both. Yeah.
Okay, and so how did you hit on 5? You just found that that was giving you the best results. You tried 10, 9, 8. There seem to be varieties.
Yeah. So, I like the weekly charts. When you have a breakout on a pattern on a weekly chart, it's very powerful. And of course, there's 5 trading days in a week. So I'm like, well, 5 days gives me kind of a granular look at the weekly chart of what it's doing. So I like the 5 day. I just find there's, believe it or not, there's like a 3 to 5 day cycle that constantly happens, a short term high, short term low. And I like to identify those. If the market is in a strong trend, it's naturally going to be riding and bouncing up the 5 day. If it starts to weaken, it'll close below it and be stuck underneath it. It's a very good momentum tool, and so it plays a role, kind of acting like a weekly chart, but you get a very granular look on it. The 9 day I used to use. I used to actually use one called the 8 day moving average. Two of them. One would be the based on the open. One would be based on the close. And so they track very closely together, but depending on how it closes, you have these crossovers that'll help you identify, hey, this was a weak close. It's actually going to affect one moving average and say, hey, it's actually showing signs of weakness. So there's all kinds of ways you can do it. The 8 and 9 day moving averages are really good. They're half of the 20 day that I love. And so anything from 20 all the way down to 5 play a very important role. They work very well for short term trading. It just depends on how you use them exactly, and what kind of trades you're trying to pull out of the market.
Are you mostly looking for a crossover? when short or long. That kind of like a signal.
Yeah, not so much a crossover. Like, I guess the crossover would be if the 5 day moving average is crossed up above the 20 day, that's a good sign. Price also needs to get above there. When those two are above the 20 day and the 20 day is sloping upwards, I'll be like, okay, any pause or pullback can be bought. And then you can ride those trends. And when it pokes through a new high or it gets overbought short term with a basic standard deviation like a Bollinger Band, you can be like, hey, you know what, I'm going to pull a little profit off. Every asset class has its own volatility, right? So some of them will move percentage wise bigger. So you have to understand the characteristics of each asset, and you put a different Bollinger Band based on how that normally moves, the volatility, and whenever that particular asset hits its upper range that it typically hits before pausing or pulling back is a good spot to lock in some gains or move a stop up, and all that. So really, it's not about the crossovers. It's just identifying 20 days up, 5 days above it, prices above both of those. Any pause or pullback from there is an opportunity. And that's kind of how I look at that from a swing trading perspective.
And is this for stocks, or will you use this across all kinds of assets from forex to commodities?
I really focus on the U.S. indexes, like the SP 500 is my core thing, and my whole thing is if you can nail down the movements in the SP 500. So when you know when to buy the SP 500 or when to sell it, then you just carry that over to stocks or sectors, and so they're all kind of related. And the key with me is I'm a surfer, kind of like a waterman. I love being in the water, on the water. I surf. I like to look at the stock market like the ocean. So, when in a rising tide, it lifts all boats. In a falling tide, they all go down. The stock market to me is the same. If you can identify the tide, the trend of the SP 500, if it's going up, most stocks are going up. So if you have a buy signal in the SP 500 and the trend is up, go look for something more leveraged if you want, like a sector or an individual stock, and then look for a shorter term signal on those if you want to. But I'm a huge fan of understanding, is the tide up, going up or down? And then another perspective to look at it is, if you're walking down an ocean beach and there's surfers kind of floating out past where the waves break, what are they doing? They're waiting for that set of waves to roll in. Every 5 minutes or so, there's a new set of, bigger than normal waves. And the stock market has these waves rolling through assets about 5 to 12 times a year. And so I sit on the sidelines. I wait for these waves to start rolling towards us. And when it's in an asset class we understand, it fits our risk criteria, then we can hop on that wave, we can ride it. And the nice thing about catching these waves, these strong waves, is you can also gauge when they're getting weak. And so you can trim profits, you can move stop up, you can be mentally prepared that, hey, this is about to end and it's not going to be a shock because we can see it weakening. So it plays a lot of roles in entry and managing positions and your emotions. And the emotions are probably the, the most important part, other than having an exit strategy. Because I see this all the time with traders is we get into a winning trade and then we hit a profit target. The first wave of emails I get right away is like, why are we getting out? It's making money. I'm like, well, you have to take profits or you might not ever make any money. Like, and then of course, when a stop gets hit, I get a wave of emails like, why are we getting out? You liked it. It's still in an uptrend. I'm like, no, yeah, you just have to bite the bullet. You have to manage positions. And most people don't know how to manage. And it's all because their emotions override, right? They believe in something and they're going to trade on their beliefs and their wants, that they want it to go higher or that it'll recover before they have to exit getting stopped out. And so those are kind of some things, the way I look at the markets.
How do you assess where you want to exit? And will you use Fibonacci tools for that, or will you just look at past history, momentum? Is there a combination you can talk to us about?
I like to use, so if it's a discretionary trade, like for example, we did a Bitcoin trade a couple months ago and it was based purely on chart pattern and Fibonacci. And we got in and we caught our first move, which was about a 14% move in 2 days. And then it rallied, 40+% about 3 weeks later. That was purely based on chart pattern and Fibonacci. But when I'm trading the overall indexes to get a gauge of what the markets are doing and to move our portfolios into bigger positions, I don't use Fibonacci. I actually use past price action, figure out the average moves and waves that happen in it percentage wise, and then be trimming profits off when the indexes hit these specific levels where it typically runs out of steam and has a pause or a pullback. So we use past history and current volatility levels to adjust where our first targets are, where our stops are, and then we just kind of navigate that way. So it's fairly dynamic. You do have to. The market is like expanding and condensing all the time. And you do have to open up targets and tighten targets depending on the market condition. And kind of leads to another thing, which I believe there's four stages to a stock market, and every stage requires a very different strategy, and people don't realize that. And only two strategies are really good for trading. So, are two stages. And people use one strategy for all four of them, and they wonder why their strategy doesn't work very often, right? They go in waves where they make tons of money, they think they're a superhero, and then they give it all back and they're out of favor for a long time. And that is one of the biggest things, is knowing what stage of the market we're in, what strategy to use, and that sets you mentally prepared for what to expect, how difficult or easy trading should be. Because there's times when you get into trades and they just keep running and they all work really well. And then, as you know, you get into other times and it's like, oh, it's been the worst year ever. It's like everything I get into fails and rolls over. And, so that is a key aspect that most people don't understand or know how to even identify. And it's, I mean, all these are equally important. You have to know them all to do well, but it's another important piece to the puzzle.
Is that knowledge that you have now acquired through experience purely, or do you have kind of like tools, software that you can call upon to help you identify areas of volatility and so on?
Yeah, so I learned it from a book from Stan Weinstein years ago called How to Profit from Bull and Bear Markets. He teaches you what the four stages are and how to identify them. It's based around more or less the 150-day moving average using a daily chart. I have an infographic. If somebody was to join my free newsletter on my website, they get the download of this infographic. It breaks the market down, showing the stages, how to identify them, the mindset and expectations people have, which are always totally wrong at the worst possible times. It shows you what sectors come in and out of favor during different stages and what strategies to use different stages. So I learned it from Stan and his book, and I've carried it over, and I live and breathe by it. And these four stages happen on any time frame. I like to look at the daily chart. It tells us if the tide is rising or falling, the bull or bear market, but you can use it on a 1 minute chart. You can use it on a tick chart, a 5 minute chart. The stages are like a basing stage, stage two, which is a bull market, a stage three, which is a top, and a stage four, which is a decline. It's just a cycle. It's just a wave. They have different characteristics, and you need to know, what stage you're in on any chart at any time, and that'll give you a gauge of what price action should do and how to trade it.
In terms of research, for stocks that are about to break out, make a really strong move, are you using tools like tip ranks or anything similar to that?
So I use eSignal, which is just a charting platform. I kind of am grandfathered into it. I've used it for maybe 20 years. I built a lot of my trading software, my trading strategies are all built in it, my indicators. So I have created tools that automatically identify these stages and the buy signals and overbought, oversold levels on the charts, from a 30-minute chart all the way to the weekly chart for long-term investment signals, bull and bear signals. Um, but I don't use any other third party. Everything I use is all stuff that I've built, I've programmed. I use a lot of inter-market analysis, so I need to know what utilities are doing, gold's doing, what bonds are doing, interest rates are doing, all these different things, and where money's flowing and which trends and stages they're all in. That will tell us how strong or weak a particular wave is in an asset and in the stock market, and that really kind of gauges. It does a lot of work for us. There's a lot of moving parts in there. It brings in time cycles. It brings in technical analysis like higher highs, higher lows. That's the definition of an uptrend. Tells us when not only the technicals, but the market sentiment. And by knowing what all these other assets are doing, if they're going up, money's flowing in or out, we can tell what people are thinking and what they're doing with their money. And if you know what they're doing, if it's strong enough, you jump on board and you take advantage of it. Or if it's a contrarian signal, you'll be like, okay, these people are going in the wrong direction and we can bet against it. So there's depending on the strength of moves, we'll gauge, do you join the herd of fish, or do or are they telling us it's about to change direction?
What do you make of the last year or so of news on the stock market and the economy and how they seem to diverge? There's there seems to be a plethora of bad news, and economic data coming through that says any minute now going to have a recession. In fact, we had all of that last year, and yet the
Hmm.
stock market continues to is now extended, isn't it? Quite dramatically. I mean, end of February now as we would record this, and we've got this double top, and the stock market is coming down. Well, the indices are coming down quite heavily. How
Mm.
far they go, who knows? But it is for me anyway. It's been one of those years where I've been hesitant to go long on stocks because there's so much news that says no, any minute we're going to have a crash. We're going into a worse bear market than ever before. How have you
Yeah.
managed to cope with that? I mean, do you sort of filter out all that noise and just keep very focused on the charts and say, well, it's telling me we've still got more to go?
Yeah, I mean that's definitely tough, right? It's I've been bearish on the markets for a couple of years, really since like 2021. I was like, okay, this is a major top, and it has been a major top for the majority of stocks. I mean, if you look at the Russell 2000, it really just put in a major double top in the past 2 months from the previous high in 2021. That is not a good sign. But overall, you need to break the markets down to a couple strategies. Like we have a long-term investing strategy based on the SP 500. It is still in a bull market. It's still trending higher. From a long-term investor standpoint, you should still be long. From a shorter term, more so like the 20-day moving average style strategy, we're back on the sidelines. The recent pullback has said, hey, this trend is coming to an end right now. Step aside, let it figure out if it is going to start a new major downtrend, or let it at least trade sideways, build a base. And when it starts to run higher, if it is showing signs of strength, we'll get long again. So you really have to kind of follow price and try not to let the emotions get in, or else you'll be sitting on the sidelines. So many people are on the sidelines because they're worried.
Yeah, I mean, Buffett is famously taking his money out, right? Well, he's selling
For
his
sure.
stocks, so
Yeah,
he
he's been
clearly feels, we've done enough. Let's have some cash and we'll buy lower.
For sure. Yeah, he definitely is being the most protective he's ever been. I think it's record cash. I think 30% or more of his portfolio is in cash. He also has so much money. It takes him months and months to raise that cash. He
Of
can't just
course.
dump positions. Like we can get out of a trade in a blink
Yeah.
of an eye
He
for like
doesn't
a
want to be
buck.
the one who tanked the stock market, right? Yeah.
Exactly.
Yeah.
He unloads like billions of dollars, repeatedly over
Yeah.
time,
Yeah.
trying to secretly unload, huge positions.
Yeah.
But yeah, it's difficult, and you really do have to follow the trend. As bearish as I am, we are still long as an investor, and I still think this market might want to push a little bit higher, one more little trade to the upside before it actually rolls over. But I think this is the year 2025 that we go into a huge correction. I think we're going to see that financial reset. I think we're going to see a lot of things: commodities, real estate, equities markets. They're going to get hit very hard, and it's probably going to take a few years to recover. And we're going to come out the other side of this, I think, financial reset and recession. It's going to be a very different world. It is going to be like an AI driven robots. I mean, it's going to go dark and we're going to come out rising with robots. It's going to be weird. It's kind of a
Yeah.
scary scenario, but if you don't embrace it, you're going to get left behind.
Yeah, for sure. Do you short in market conditions like we've got right now, or will you just sit on the sidelines?
No, so we won't short unless we are in a full on bear market. And we don't actually short, we buy inverse ETFs, which is the same thing, except for just a little bit. A lot of people can't short because it requires a special trading account. There's extra risk to shorting. So you just buy an inverse ETF, which means if the stock market falls 5%, the ETF goes up 5%. And you can buy leverage. Right now, in this market condition where the market's pulling back on a short term basis, we don't short it. What we do is we go to a different asset class. We could go to the US dollar index. Typically, when there's blood in the streets, we see the dollar go higher. So you can buy an ETF for that. We could go to bonds, long term treasury bonds, if they're in an uptrend, which they're not really right now. Or we just go to a cash ETF where you just earn literally daily interest and a monthly dividend payment and wait for the dust to settle. Protect your capital until there's a new wave, a new opportunity, and then we move back in. So it's not about trying to benefit from falling prices quite yet. We need a stage 4, which is a decline, a financial reset, where on average, every week or every month, price is going down. That's when we start to buy inverse ETFs. And it's a long ways away. We need a lot of to go down at least 20% before we even start a stage 4, like a technical decline from that perspective. That's again, it has to be a full on financial reset to be shorting the market.
Wouldn't there be a risk that as soon as it gets that low, it's going to bounce back up if you're going to short? That's one thing that always worries me about shorting, like, the Dow. It'll come down
Mhm.
really hard and then come up just as fast.
For sure. And the sharpest rallies in the stock market happen during a bear market. Like they are sharp knee jerk reactions. You'll see a 5 to like 15% bounce like within days, right? So trading the downside is a very different game. Again, we have shorter term tools that allow us to play these bounces and see when the sentiment and momentum is shifting. And if something bounces up and then it starts to go down, that's when we'll jump into the inverse because it's likely to go down because the long term and the short term trends are down. But they're very swift trades. So in a bull market, a trade will last us usually on average about 40 plus days, which is a couple months. There's 20 days trading days in a month. In a bear market, when you buy an inverse ETF, usually the market's just rolling over and it drops very quickly. We might only be in that trade for 5 to 10 days. We hit our targets and we eject out. It's not about trying to stay short or benefiting from consistent falling prices. It's about catching the next waterfall and then jumping out because you're going to get one of those sharp bounces you just said. So it's about hitting quick targets on the free fall and moving aside. And it's not about trying to make as much as you can. It's just trying to make some during a sweet window. Get in, get out, wait for another bounce, and then a new setup once again.
What proportion of your trading is intraday and or even scalping?
Zero now. I mean, maybe once a month I'll do a day trade. I still love trading futures, the SP 500 futures. So if there is a particular trade setup, like if the market is rallying all day or it's selling off all day, when there's an extreme scenario and all my sentiment indicators on the intraday charts are screaming, I'll I'll put on a counter trend trade. Right at the end of the day, I'll actually put on an inverse. I'll bet against the trend. There's usually a quick pullback or a short squeeze depending on the direction, and it'll be a trade that lasts maybe 10 to 20 minutes total in the last half an hour just to squeak out grand or two really quick. It's my signature trade. It's like the counter trend trade for the day. It's just something I have a way of identifying, and it's nice because I see the patterns play out all day, and then I'll be ready for it at the end of the day. But other than that, I don't really day trade at all anymore, unless it's a perfect setup once or twice a month tops. My focus is managing my entire portfolio using ETFs. I only do ETFs now, so I can move all my money in and out very easily. ETFs move much slower than individual stocks. I don't want crazy volatility. I just want to catch a rising tide and catch that wave, get in, move out, find the next wave. I find it much more relaxing. Again, there's only 5 or 12 waves that roll through the market every year. So that's, you know, one to, half of a trade every month. It's very easy to follow. I use end of day signals. So I don't need to watch the computer during the day. I wait for data update after the close and I'll be like, hey, we got a signal today. And the strategy is nice because I can identify when a trade is coming. I can see it usually 4 or 5 days in advance. So going, okay, we're getting close to a trigger based on the momentum. We're going to get a trade this week or next week. And so I'm already mentally prepared. And same when we hit targets or when we have a trend exit. If the market is losing momentum, I'll be like, it looks like we're about to lose our trend signal in the next couple of days. So it's really nice because you see things coming ahead of time. You're already mentally prepared. You can have your orders already, standing and ready to go. And that fits my lifestyle. I do a lot of different stuff. I'm big into real estate and inventing things. I do a lot of consulting and traveling and stuff. I do all kinds of stuff that I love to do, and I don't want to be glued to the screen. I used to day trade all the time. That's all I did. But it's a job, and when you're hunting and looking for trades every day, your brain will find some, but they might not be good trades. It's just because you need to find trades to make money. So I really try and go away. I'm like, how can I make the most amount of money with the fewest trades possible with my entire portfolio? I don't want to put on 700 trades through the year. I want to put on 5 or 12 trades and watch my entire account just slowly kind of grow in a very consistent, controlled manner. And I find that easy, time commitment wise, stress wise, and obviously it's much easier trading 1 or 2 positions at a time than it is a portfolio of all kinds of fast moving things.
Absolutely. Which are your favorite ETFs, say the top three or four?
Yeah, the ones I really focus on for my portfolio is SPY, QQQ, which is the SP 500 and the NASDAQ 100, TLT, which is the long term US Treasury bond ETF, um, the UUP, which is a US dollar ETF, US dollar index, and then just BIL, which is a cash position more or less. It just pays you daily interest and a monthly dividend payment. So you can sit on the sidelines and still be in a position and continue to kind of slowly grow your money and get paid while you wait for another position. So those are my favorite. That's where I manage and control pretty much all my portfolio. They're pretty boring. People always want sectors and stocks. But I find if something's boring, it means you've got it figured out and you've got a system in place. If you find it exhilarating, then you're swinging for the fences and it's fast moving. And to me, I don't want to risk my lifestyle. Don't want to risk my portfolio. I like boring because I don't have to worry about it, and it
Yeah.
becomes more predictable.
Yeah, I mean, this is the trouble with these volatile stocks or volatile anything. You have these great days, and then the next day you give it all back.
Yeah, yeah.
Too often, even experienced traders.
For sure. Yeah. They're
Yeah,
fast moving. It's
yeah,
volatility. I always look at like when you have fast moving stocks and Bitcoin and sectors, to me, it's always like one of those bug zapper lights for mosquitoes. Volatility is like that light and it just lures traders in because they're like, oh, I can make fast
yeah,
money.
yeah,
And I'm like, man, you're just going to get zapped. You jump into that volatility. It's funny because as the markets get more volatile, my whole strategy steps back from volatility. So generally we want to be long the stock market, which has the most volatility. But when it starts to get crazy, we move down to bonds, which is slower moving. If bonds aren't a signal, then we'll move to the dollar index, which is even half the volatility of bonds, even less than that. And then we'll move to cash. So as volatility comes, we're actually going away from the markets and volatility, yet everyone else rushes in and they
it's
want to trade
interesting.
2x ETFs and like swing for the fences and make quick money. The masses generally do the opposite of what you really should do, right? But that's the reality of it.
Yeah, yeah. The trouble is that you rush into this volatility, wanting this faster movement, excitement, the quicker money, right?
Mm-hmm.
But that also turns you into a bit of a gambler because you
Yep.
you go, oh look, I can make that money. I'll do it again. I'll do it again. I'll do it
Yeah.
again. And then of course at some point you go too far and it just slaps you in the face.
Yeah.
You know?
Yeah. They hurt. The fast moving things hurt. Most people are trading on emotions, they're trading on fear and greed, and they can't follow, they don't have a strategy. And even if they do, they generally don't follow the rules to get out. They're always like, oh, it might bounce back tomorrow. I'll get out at a higher price. And it keeps falling and falling. And they end up holding. A lot of people, you look at their portfolios, they have a ton of stocks and ETFs that are down like 50, 60, 70%. They've had them for years because they just refuse to exit for a small loss the day it didn't work out. And it turns into a lifelong investment and loss. And it's a drain on the brain. It's painful. Like just nip it in the butt right before it gets ugly. Just move on. It's a loss is a loss. I always tell members when we get out of a trade and it's a loss or we get stopped out, I'm like, I congratulate everybody. I'm like, if you got out, congratulations. You are a dedicated trader investor who actually has self-discipline. If you didn't get out, good luck. I know how this typically ends over the long run. And if you don't help people, because a lot of people just don't want to get out, right? You need self-discipline and nobody wants to be a loser and they hate to take losses, but you got to do it.
Yeah, and you can't even really spend too much time regretting whatever choice you made either. Whether you could have made more money or you held on to
Yeah.
it too long, whatever it is, you got to just look at that as a lesson. What did I learn here? Forget all the regret. Either
Yeah.
way,
Yeah.
what's the lesson I learned from this? And you just got to focus on that because for one thing, if you don't, you'll probably make the same mistake again, and you're just making yourself miserable, and that's you're going to carry that emotion of misery and disappointment and so on into your next trade.
Yeah, I mean, I blew up 3 trading accounts when I was younger, and it was all because it was pure emotions. It was trading futures, and I kept average. I bought the SP 500 thinking it was going to bounce, and it just kept falling and falling. And this was my second trading account. By the end of the day, I'm like, I kept averaging, adding more contracts. I'm like, all I need is just a bounce into the close, and I will at least get back to break even, and I'll be good. And the market just kept falling into the close. And then after the close, you get a margin call. and all my money was gone.
How much money was that?
It was a tiny account. It was about $7,000, but gone in one day. My whole account, 100% of my account gone in one day. What was I? I think I was maybe 20. So it was a lot of money for me. That was
Yeah, that's
US,
all
which
it
is a
is. A
lot.
lot
It
of
was
money
like,
for anyone,
12,
really.
12
I mean,
grand
well,
Canadian.
not anyone, but yeah. I mean, certainly for a young person.
Exactly. It was a lot for me. And I ended up scraping together another 5 grand US. I put it back into the trading account a few weeks later, and I got into the same revenge mode. I'm like, okay, I'm just going to swing for the fences. I'm going to wait for my perfect setup, trade futures. I'll make my money back, and then I'll calm down and I'll trade normally. And the same day I started trading it, I opened it, I blew it up doing the exact same thing, and I stopped trading for months. It shocked me. It really rattled me to the core, confidence wise, in every way possible. And that was when I kind of hit rock bottom. I'm like, okay, I had done very well up to that point, trading stocks and all of that, because I started in 1997 and I had lost everything that I had in my stock trading account. And then I lost everything in my futures account. Learning that fundamentals didn't work, leverage, emotions don't work, all of that stuff. And that was my wake up call of, okay, I need a strategy. I need rules. I need to actually be like, man up and have self discipline and just take a loss. And now it feels, as much as I hate taking a loss, it feels so good when we get stopped out and we move back to cash. I'm like, okay, that didn't work. Reevaluate, why did this not happen? It doesn't mean we did anything wrong. It just means the market didn't work in our favor. And sometimes we're just totally wrong, or the analysis or the market flips. And now even subscribers say the same thing. We get out of a trade and they're like, man, it feels so good to get out before things get ugly. And I mean, we got out, just a couple of days ago, and the market just keeps free falling right now as you and I are recording this. And people are like, man, it's so nice to know when a trend changes and the momentum shifts, and we're sitting on the sidelines collecting interest, and we can wait for a fresh setup. Um, so yeah, it's
So after your youthful disasters, how did you sort of reassess your approach? I mean, did you think, right, I'm going to trade ETFs, I'm going to trade on low leverage, I'm going to trade smaller sizes? But what was your sort of plan?
Yeah, I mean, I was still learning at that point, so I still did a shotgun approach. I did a lot of different stuff. I still did some day trading, mostly just ETFs. I was only trading triple leveraged ETFs back then, which I don't even know if there are triple leveraged in the US anymore. There was a bunch of new rules that came out. Um, so I was trading triple leveraged ETFs. I was still trading a little bit of futures, the odd little trade. I was very, very gun shy. I did not want to lose when I put money in. And I also got into penny stocks, uh, pretty big. And one of my biggest, or my best trade on a penny stock was I made about $127,000 overnight on one penny stock, which kind of re-injected my accounts. And that was my best trade pretty much ever in terms of how quick it came. So I kind of got addicted into small cap stocks for quite a while, played the precious metals rally in 2008, and did very, very well. And then once the more money I had, the more I didn't want to risk it. And I had gone through a bankruptcy. My parents went bankrupt. And so we had been to the top and came all the way to the bottom financially. It was pretty devastating. My dad had started having seizures, stress. We thought he was going to die the first time he had one. I didn't know what was going on. And that was when I realized you can be at the top of the food chain, lose it all, and not only lose money and your lifestyle, but friends and potentially your life or your health. And that was the real wake up call for me. So I naturally gravitated to, how can I trade with less volatility and trade my entire account. I didn't want to trade a lot anymore. And that's when I moved to ETFs and started just not using any leverage. I don't use any leverage anymore. My strategy is designed to catch these 5 to 12 waves every year, and we compound our growth. So as we make money on one, we reinvest all of it in the next one. And so by compounding, you get unbelievable, more or less, leverage. Compounding is one of the strongest forces in the universe, but you don't have to use leverage, and you don't get that increased volatility that comes with leverage. So I have a very conservative strategy with no leverage, but we compound our growth throughout the year, and it creates big returns without increasing risk. And it's a totally different way of doing things. I call it asset revesting. We take our money, we reinvest it into a new asset, whatever wave is rolling through. And so that's how I kind of migrated to ETFs, and just compounding growth and focusing on the indexes. Is the tide going up or down, depending on the direction, is how I'll attack the markets with a long or short position.
Yeah, so with the compounding, you mean you'll get in and down here, and then you'll get out up here. You'll reinvest that profit that you've made into an alternative ETF that is making a stronger move up to avoid the
Yeah.
downward move, right?
Yeah. So if say we have $100,000 account and we make 10% on it. So now we have $110,000 and we close that trade. So instead of just putting that same 100,000 into the next trade, we're taking the whole account, the 110,000, and moving it into the next trade. So we're growing. Every gain we have is on top of our previous gains, which is the compounding effect. And that's what really can amplify things in a big way without creating volatility. Because what happens is if the indexes naturally move, say a 5% fluctuation, that would be like our stop level. You only have a 5% fluctuation. But if you use, and with compounding, we're just constantly getting in with that same 5% wiggle room of a stop. But people who use leverage, like a 2x ETF, well, now you have twice the volatility. You have 10% volatility for that account. So, the compounding allows us to have a very conservative strategy, but get the power of like a 2x or a 3x ETF without the volatility. And with volatility comes emotions, and people break rules and they can't handle it. It's, that's when the discipline comes in, and you need a very detailed strategy, and you have to believe in it and be able to pull the trigger on those things. So, um, to me, compounding makes investing so much easier because you don't get that heightened, leveraged emotional swing that scares the heck out of you every time the market moves.
Yeah, no, it does make sense. And how did you, I guess you started this in your mid 20s, this kind of approach, take out the leverage, ETFs, build a fund. I mean, that's another thing I wanted to ask you about. You're talking about a company that runs a fund, basically. You've got clients. How did you build that up? I mean, you ran your own account, possibly your dad's as well, got a track record, then went out to approach people. Is that something like that?
No, actually, totally different. So I don't run a fund. What I do is I simply manage my own money, and I share my daily analysis and my ETF trades with subscribers. So they would just pay an annual fee to have access to my newsletter. And I teach, and I share videos on the market, what's going on. I say, okay, tomorrow I'm buying SPY ETF at the open with 50% of my portfolio. Once we get in, I send out another update saying, here's our stop level, here's our first target, how much we're going to sell. So I just share my insight, my analysis, my thinking, and the exact trades I'm doing. So you can just ride my coattails, copy exactly what I do, allocations in my portfolio, and they do their own. So I don't manage money. I don't touch anyone's money. That gets into a whole new kind of ball game and regulations and all that
Yeah.
stuff, and it becomes a real pain in the butt. So
Well,
I
you
just do
tried it,
I
or
just
you
do what
know
I
people
need to
who.
do, and I share it with others. And we're just a big community. We all help each other, and to have a good time trading and investing in the markets.
Sounds good. And how often do you put out your newsletter?
So pretty much every morning around 8:30, I put out a 8 to 15-minute video. I recap kind of what happened on all the different assets the previous day, what happened in overnight in pre-market trading. And then I show the charts. I'm like, here's what we should expect today, how it might affect our positions, what you're going to probably be feeling. I have custom indicators that tell us when there's panic selling or when there's FOMO buying. And so I can gauge, and I know what a lot of people are going to think and feel as soon as the market opens, or what they're already feeling in pre-market if it's a big move up or down. So I really am just um, keeping people up to speed on the markets, and I'm really trying to help them from an emotional standpoint. Don't freak out about this gap down or this gap up today. These are normal. We're going to see a huge wave of FOMO or panic selling today. That's the masses not knowing what to do. It's actually a good sign. So I walk people through the chaos, and the chaos actually gives us comfort. When there's panic selling or FOMO, we actually have a much clearer picture of what the market is going to do, because extreme situations are very, very predictable. And so we actually kind of almost, get get like an excitement and a high off of volatility because we have a much clearer gauge of what people are doing. It's a very straight signal, and we know what to expect for the sessions. And that's what people love, is like, wow, it's so nice to have a calm, cool, mind and view on things, and outlook of how this day should shake out. And that's what they like, is not being fearful, because everybody still listens to the news and the media and economic data, and it consumes them. News is designed to get your attention and to spark emotions. That's the only way they're in business, is they keep you lured in with emotional, you know.
Yeah, and it's mostly fear as well. I mean, certainly, the YouTube channels that I watch, they're full of fear and God, it's terrible, the inverted curve and uninverted and all the rest of it. And it's just every bit of data you ever see is
Yeah.
guaranteed to create a crash tomorrow.
Yeah, exactly. It's I can put out a really educational video on my YouTube channel, and it teaches and is so good, and people just don't really want to watch it. And then I put out a title that says, markets topping, about to fall 57%, and it's
Yeah.
just a basic update, and it goes ballistic, and everybody chimes in like, "Oh my gosh, this is so amazing!" I'm like, it's just people. It's hard, but yeah, fear is powerful.
Yeah. End of February. I mean, do you have any kind of prognosis for the spring now? We're looking at the spring and the summer.
Yeah, I think it's going to be very, very choppy right to May. There's this typical saying, "Sell in May, go away." Based on my cycle analysis, I think the market might want to try and push a little bit higher, but by the end of April, we have, I think, April 27th, somewhere in there, the stock market cycle shows that it should turn down. So uh, I think it's going to be very volatile, and I think the markets will be heading down going into the spring. By May, I think the markets will have probably turned down or already down dramatically, and we'll be well on our way to starting a new bear market, and potentially that stage 4, like a financial reset, like the 2000 tech bubble reset or the 2008 financial crisis, both of them down well over 50%. As you were saying before, valuations are so high, everything's overextended. I mean, we haven't seen this level since 1999, and back in 1920s, the last major, where the market blew up to the downside, collapse. So yeah, it's a scary time, and people need to have a strategy to step aside or benefit from it. I mean, there's going to be lots of potential from chaos. There's a money. The market falls a lot faster than it rises.
Yeah. You look at the American indices, obviously the S&P and NASDAQ and so on, and you compare those to the British, the FTSE 100, and the German, the DAX. uh, you could say the Americans are overextended, but if you look at our index and then the German index, I mean, we're in a really shitty state economically. Germany apparently is in a recession, but the DAX looks like a crypto going straight up to the moon. I mean, what the hell's going on there? I mean, as far as I can tell, it seems to be something along the lines that there are so many billionaires around the world that they're just moving their money out of whatever might, I don't know, bonds, whatever they usually put it in, just
Yeah,
to take a speculative punt, as it were.
yeah. Yeah, eventually it'll run out of steam. I mean, I showed a really interesting comparison. If you take, there's all the different country ETFs. So you can gauge all the different countries, just like the German DAX and all the different exchanges around the world, including Canada. And when you layer them all together, you'll notice they pretty much, like, they're not day to day in sync, but when the US market is crashing, so are all the other ones. Like when it's rising, whoever's the leader, I don't know who the leader is, but they pretty much all move in sync. Either we're all in a bull market together or a bear market, just some move more or less than others, but the tide is generally the same. They're either naturally going higher or all naturally kind of going lower. And so the whole diversification thing really always throws me for a loop. All these people are like, "Oh, I own this country and that country, and I own bonds and stocks, and I have these things and those things." And if you look at them all and overlay them all, what happens during a financial reset? They all go down. I mean, diversification doesn't help you when there's net outflows in every asset and everybody's fearful and selling. You need a different strategy. And diversification sucks during a rising market because you're going to have the indexes or your stocks doing well, but you're going to be holding a whole bunch of other things that are going to do the exact opposite. So they kill the performance of your winners, and you end up with that, typical buy and hold return. It's like, 7-8% over the long run with massive volatility. You're going to lose your wealth, half of it, multiple times through your lifetime if you don't panic out. Um, so yeah, it's you got to be aware of pretty much the markets all move together. The world is really just a big hive, like a hive mentality. When it, right now, money's still flowing into equities. You don't really want to fight it yet, but eventually that flow is going to turn the other way and everything's going to go down. And you got to wait for it to bottom before you get in. People always try to pick a bottom, and it's usually way too early. And the biggest drops usually happen right near the end of a trend. So people will be like, oh, this looks like we're getting close to a bottom. And they get in, and then the bottom drops out and it collapses, they're 5, 10, 20%. And they'll be like, oh, what are the odds? I'm like, well, they're pretty good, actually. It's just
Yeah,
the
because
way
you've already
mentality
experienced
works.
it. Yeah, exactly. Yeah, it's kind of one of the first things you experience as a beginner trader, isn't it? You think, oh, it's come down such a long way, it has to go up, but well,
Yeah.
no, it can still go down.
Yeah, I always say, like, I mean, I've more people lose money in penny stocks. There's a reason they're penny stocks, because they just keep going down. And people are like, well, it's a penny. How much lower can it go? I'm like, it can go to half a penny. It
Yeah.
can go to like a quarter penny. I mean, it can go to a tenth of a penny. Like, anything can still get split in half and still go down another 99%. Like, just because it's cheap, people think it can't go down much more. I'm like, it doesn't matter what the price is. It can still drop 50 or 100% almost. Like, the cheaper something is priced, the more odds are it's going to go down. It's a startup. It's struggling. Investors aren't, it's not a strong company paying dividends if it's like, an 80-cent stock or 20-cent stock. Um, yeah.
Are you already preparing for the moment the stock market comes? You mentioned April as a possibility, or May. Are you making plans as to how you might strategize during those periods?
Well, we've already raised a lot of cash. Like, our shorter term strategy, we're in cash right now. Long term investing, we're still long the equities market. Outside of the stock market, because those sides are dealt with our positions. So, I'm moving out of some real estate, selling some real estate property right now, a self storage facility. Want to lighten my load. There's not much upside potential really in that. It's maximized. It's full. I think there's going to be lots of opportunity after a financial reset, and I can get into either different real estate like multifamily, or potentially another self storage facility, or make a new one. Who knows? Or potentially just reinvest into um, the stock market, or whatever the best opportunity is at the time. Who knows? It'll be a totally different world, I think, a year and a half from now when all this unfolds. So I like to have fresh gunpowder. I've already built assets that have maxed out their kind of value. And I'd rather find something new that has a lot of upside than try and ride something that's, kind of not huge returns, over the long run. But it's steady. But I like being creative and making money versus being so passive and taking a bit smaller returns.
Cool. Yeah. And what other businesses? You mentioned real estate. So you're already doing, your trading business. Are you involved in any other kinds of operations?
Yeah, so I have multifamily properties. I have self storage facility. I invent things. I'm working on a new project right now. I've patented and licensed out the world's first flying jet surfboard a few years ago. Now I'm working on something really cool. I actually think it's even cooler than that right now, which is top secret. This time I'm not letting the cat out of the bag because people ripped off my idea and it's everywhere. Um, and I'm also part of a movie. So we're actually, my good friend of mine who I grew up with, where he's filmed and sold 10 movies. So we're focusing on a movie. We were actually in the UK at Innovation Zero last year as keynote speakers. We're launching a teen adventure movie. So it's a group of kids that try to help save the planet through teamwork and some clean technology. And there's some climate education kind of woven in there. And it's all about teen mental health. And it's really just a really fun family movie showing kids and teenagers how teamwork and how new technologies and the way we live, small changes can really help save the planet and the environment. So we're working on that. We're going to be starting to film that late this year. Right now, we're just raising some investment capital, working on some product placements. So If anybody's interested in investing in a movie, it has a cool product they want seen, which is why we went to Innovation Zero in London, UK, because there's some technology we're going to show in our movie that looks alien, that is out of this world, but it's actually already developed and working. And we want to show the world that, hey, if we implement some of this stuff, we can dramatically change how we do stuff and improve the world and all that stuff efficiently and in a healthy way. So yeah, that's kind of one of our exciting ventures.
And this was written by your friend, the script?
Yeah, yeah. Him and his wife, they specialize in story writing and movies and production and all that.
Okay. How did you get to meet?
Him and I grew up together, so we went to high school together, and he's always been into music and in arts, very very creative, and we just kind of reconnected a couple of years ago, and he had this new project, and um, it's called GoldilocksMission.org. And so my kids wanted to be in the film, and I've invested in it. Now I'm a big part of it, helping bring it to reality. So yeah, we just have a shared passion for climate and kids entertainment, teen mental health. It's a big thing. I do a lot of fundraising and to try and help, all of that side of things.
Great. Yeah. Well, it's so good that you're not just glued to the screen all the time. I mean, I love trading, but my long-term aim is to move away from the screen. I somehow become in the last, I don't know, 2 years too glued to the screen.
It's highly addicting. It feels good. It's a
Yeah,
it's a dopamine fix. It's like holding your phone, except for
kind of.
that you can make money, so it's more exciting.
Yeah, but if you're not, unless you're really making a lot of money,
Yeah,
I think a lot of retail traders, myself included, I am making money, but I'm hardly able to justify it, the time I spend doing it. That's the thing.
for sure. And I think the reality is most people involved in the markets generally have smaller accounts, and so in order for them to make it worth their while, they have to take big risks and they have to swing a little more for the
Yeah,
fences. And it sucks because that's what causes the damage. It
yeah,
causes churning. You make big gains, but then you have big losses, and you're always back to ground zero. So that's the problem. And once people hit a certain level, well, it's just the way my brain works. Once you hit a certain amount of capital, you're like, I don't need to swing for 15 and 20% trades. I just need to make like a couple percent a month on my big large investment account, and it's good returns, and I just want to do that in the most consistent way possible. It's not swinging for the fences. It's like, how do I hit a whole bunch of first base hits, do 5 or 12 of those a year? That's your 5 to 20% return a year on your entire portfolio, putting on like one position at a time. So it's unfortunate. There's no easy way to trade and make a good living with a small account. You do have to swing for the fences if you want it to work out financially, and it's a double-edged sword. It usually backfires. So it's that's the problem with trading is yeah, you have to risk more to make more if you have a smaller account, and that's where most people are stuck. So if you can get over that hump and then change gears, the problem is a lot of people won't change gears. They get lots of money and then they still keep betting the farm and doing these huge trades. I'm like, whoa, just step back, just be consistent and compound, and you'll actually have free time. But trading is the same. I mean, I get on these day trading days and I get glued to the screen waiting for that one trade all day. At the end of the day, I'm like, oh, this is gonna be a perfect day. It consumes you, it sucks you in. Like, it is very satisfying. I mean, we're all in trading because we love it. It is addicting. It feels good. It's a challenge. It's a rush. You're in a trade. You feel your neck throbbing, your blood pumping. You're waiting to scale in or scale out. There's no doubt about it. It is a fun game,
it's a real
sport,
challenge. Yeah,
business.
kind of a game.
Yeah,
Yeah, yeah, but
yeah,
it's kind of intellectual to a degree as well.
yeah.
It's everything, isn't it? It challenges your emotions, your mental acuity, so many
Patience.
things. I
Yeah,
think it's if you are a performance type, you love the performance. Um,
yeah.
I mean, my background is in sort of music and performance to a certain extent, and I think that's part of what drives me to do what I do. With the trading,
Yeah.
I love that sort of challenge. It's
Exactly. And that's what actually got me into one of my core parts of my strategy is based around music, based around noise, sound waves. And it transfers over into the market using cycles and waves, emotional waves. I mean, everything in the world runs on frequencies, right? and everything is vibrating differently. And when you find the resonance, which is constantly changing in the market, as emotions and fear and greed, they all vibrate different. So you have to recalibrate these cycles in the market. But that's one of the most powerful parts of my strategy, is identifying the current vibration, the cycle at play, and then we use that to say, hey, we are in a bullish or bearish environment on a long term and short term. So it all came from music, from noise, from what do you call it? There's some type of scope that measures waves, sound waves. But yeah.
Yeah, interesting. Hey, well, we should pause there, Chris. It was great talking to you, and we'll do it again sometime in the near
Sounds
future.
great, Nicholas. Yeah, that was a lot of fun. Great stuff.
Good, nice one. Cheers.
Cheers.